Good morning, good afternoon, good evening, whatever time you're watching this video. This is video number 6 in our series of how to do lease options. This is more on how to do lease options. So we're going to be getting into a little more detail today with the numbers side of it. Once again, this is Pip Stellick, and I look forward to obviously coming on here and doing these videos because I know I'm getting lots of questions about how to do this, how to do that. And one of the things that I've been asked about is the numbers side of this. And we could do numbers all day long. I just want to make sure we understand how the numbers work. And a lot of the numbers as we go through this can be a little bit complicated or is very complicated to do the numbers. And what I'm doing is I'm going to have my phone out here so that I can do all the math right in front of you. And I'll even put my phone down here with the calculator so we can go through those numbers. And so let's say we have a property that has a $200,000, and I'm going to do some abbreviating, but you can go back and rewind this as well. A $200,000 fair market value. Fair market value. I told you I was going to abbreviate, then I start writing out, but it is what it is. It's all good. So a $200,000 fair market value on the property, $200,000 fair market value on the property. And let's say that we go out and we get a $160,000 mortgage on the property. We have a $160,000 mortgage on the property. Now we can do this with our own credit or somebody else's credit. We'll get into that more as we go through more videos. And so $160,000 mortgage on the property. And as we go through this example, you're going to start to see that there is a lot of math and there's a lot of different things that we need to pay attention to as we go through it. And so we've got this $160,000 mortgage. When we have a $160,000 mortgage, we have a payment that's going to be made on that, And so we've got this payment going out every month. We get this payment going out for what's called principal, interest, taxes, insurance, PITI, principal, interest, taxes, and insurance on that property. So we've got principal, interest, taxes, and insurance on this property. And let's just keep it simple. And let's say our payment on that for principal, interest, taxes, insurance is going to be, let's say about $1,200 for that per month. Now, I know in some areas taxes will be higher, in some areas they'll be less. But if we're looking at a payment on the mortgage of maybe about, let's say $750, $800 a month with today's interest rates, and then we look at it with our taxes, insurance, and interest, we're probably going to be up to about $1,200 depending on the area of the country that you're looking in. So that's the money that we've got going out on this property. We've got $1,200 going out. Now, on the other side of that, we've been talking about non-refundable option consideration, NROC. And the amount that we're looking for on NROC is a minimum of 3 to 5% of the fair market value, 3 to 5% of the fair market value. So in this instance, that'd be somewhere between $6,000 and $10,000. So we want somebody that's close to qualifying that can't quite qualify. Somebody who's close but can't quite get there. So if they need a higher percentage because maybe their credit isn't very good. We've talked about that in past videos. Or maybe they're not showing a lot of income because they're self-employed, or maybe they don't have a lot of credit because they're a new immigrant. Any of those issues whatsoever, then obviously they may need to get closer to a higher amount to qualify, whatever that is. And so right now they have about $6,000 to $10,000 is what we're looking for. Let's say for our example right now, they have the lower end. They actually have $6,000 of non-refundable option consideration. So they have $6,000 in non-refundable option consideration. So now we go back over here to this other side, and we know that a tenant buyer will pay 10 to 40% more than fair market rent. So if fair market rent on a property like this is, let's say, $1,200 on a $200,000 property, I don't think that's out of whack pretty much anywhere you go. If it's $1,200, a 10% increase on that would be $120. A 40% increase on $1,200 would be what, $300? So let's, $400 right in that area. So if we're looking at that, let's say that we charge them $1,500 a month, and this is the tenant buyer rent payment. the tenant buyer rent payment on that deal. And so we've got $1,500 coming in. We got $1,200 coming out for a $300 positive cash flow. Now, remember, the tenant buyer can't qualify immediately. They're going to need to qualify over time. PCF is positive cash flow. Let's say that as we talk to a mortgage lender, the mortgage lender says they're going to need 1, 2, 3 years to qualify, something like that. And so whatever time frame it is, we'll have to do all the math to work through that. But let's say it's a 3-year lease option. So we've got 36 months. We've got 36 months of positive cash flow. 36 months of positive cash flow. So if we do this math, 300 times 36, that's $10,800 in positive cash flow. Why do we like lease options so much? One of the reasons we like lease options so much, there is passive income, and that's what this would be. You have this much coming in, you have this much going out. 1,500 coming in, 1,200 going out. So you have passive income on this side. You make one big purchase, you make one big action, and you get money every month after that. And don't forget, you can leave comments in the comment section whenever you're watching this. If you're on live now, say hello. I love hearing from different people and seeing different things on there. So please let me know you're listening. And obviously, those of you guys who have questions moving forward, put them in there, put them in the chat box, whatever you need to do, send them to a personal message or for me. So we've got $10,000 of passive income. The lease option has both earned income and passive income. The other side of this is the earned income side. So our fair market value today, we're just bringing that down right now, is $200,000, is $200,000. The fair market value is $200,000. So as we start to look at this and we start to see this, we know that over time, real estate can tend to go up in value. It can tend to go up in value a little bit. And I would not use a large appreciation value. I would not use a large appreciation value, but you could use 1, 2, 3, 4% in most markets and not be hurt whatsoever. I know there are certain markets that I've taught in that we're seeing double-digit appreciation, meaning 10, 12, 15%. I owned property in Florida over the years that back in 2003, 2004, we saw 50% appreciation on properties. It led to other problems down the road, but nonetheless, in some areas you can have significant appreciation. I'm going to use a 2% appreciation. So I'm going to say at the end of 1 year, and I don't mean to confuse anybody on the math, but I'm going to take my $200,000 and I'm going to use a 2% appreciation. So I'm going to take this times 1.02. So if you do that math at the end of 1 year, it's going to be roughly $204,000. Now I'm going to round numbers to keep this as simple as possible. We said we're in this deal for 36 months. So I'm going to take a year 2 number as well. So in year 2, let's say that it goes up another 2%. So we're at $208,000. We're at $208,000. In year 3, let's say it goes up another 2%. Another 2%, we're at $212,000. We're at $212,000. Now, I don't know what you do or you don't know about mortgages, but if we start this mortgage at $160,000, we're making a payment every month of principal, interest, taxes, and insurance. So a part of this $1,200 a month payment is actually going to pay this principal amount down of $160,000. Now, you could get an amortization calculator to figure this out to the nth degree, and that wouldn't be a problem. And you would do this, and you'd have spreadsheets to do all this because that's what we do. We use amortization calculators. You can get them online for free. You can have an app on your phone. Doesn't really matter. But I'm going to say over the course of time, these first 3 years, the majority of the payment is going to go towards interest. If you've ever seen a mortgage, they're usually 20 or 30 year, 15 or 30 year type products. We pay the majority of the interest up front. They're very heavily weighted towards the interest being up front on that, on the mortgage pay down. So let's say over the course of those 3 years, we only mortgage pay down, or whatever you want to call it, principal pay down, is going to be about $10,000, we'll say. It could be a little bit less than that. It could be a little bit more, depends on interest rate. So why is that important? At the end of 3 years, we are going to sell them the property for $212,000. We're going to sell them the property for $212,000. How much do we owe on the property at the end of that 3 years is 160 minus 10,000 or $150,000. So if you take 212 minus 150, 212 minus 150, that's $62,000. We have $10,800 of positive cash flow on this other side. So that gives us 52,000. Wow, that gives us 72,000. Can't do my math tonight. $72,800 in profit before we have to pay back our down or account for our down payment and things like that. And so we've got $72,800. Now, this non-refundable option consideration, you can do multiple things with it. My opinion is you give that money back to them because they're going to need money to put down for the property. So if they've got a $212,000 property and they're going to need, according to the mortgage broker, they're going to need, let's say, 4% down. They're going to need 4% down. They've got 6,000, but they're going to need 212,000 times 1.04, probably just times 0.04. I think I hit an extra clear there. 212, can't do my math tonight, times 0.04. They're going to need $8,480 down. They're going to need $8,480 down on that property. That's what they're going to need for a down payment. And there's nothing, that's not out of line whatsoever. 4% is a pretty good deal for the tenant buyer as well. So they're going to need $8,480 down. How much did they give you up front? They gave you the $6,000. They gave you that $6,000. So subtract out that $6,000. They're still $2,480 shy of where they need to be. Now, we teach this in a way that if they need $2,480, I would take that out of my profit. Why would I take that out of my profit? Don't be greedy. There's an old saying that pigs get fat, hogs get slaughtered. And so I would take that out of my profit to make sure they had the $8,480 that they needed. They've already given us $6,000 up front. So there's 6,000 reasons why they're going to follow through with that deal. 6,000 reasons why they're going to follow through with that deal. And what we're going to do is we're going to make sure they can qualify. So we have 70,000. What would that be? $320 of profit. $70,320 of profit. What's the first thing we have to do? We had to put down $40,000 for a down payment. So let's take that out of the profit scenario here. We take $70,320 minus the $40,000 in profit that we had, and that's $30,320. That's $30,320. Now, I know this math may get challenging for different people because you're not used to it, and that's not unusual. First time I had to do this math, I didn't understand it very well either. But if we have $30,320 in total profit, and I'm going to get another sheet to write on here because I'm really running out of room, $30,320 in profit. If that's truly our total profit, we're in this deal for 3 years. We're in this deal for 3 years. And if we're in this deal for 3 years, what I'm going to do is I'm going to divide that $30,320, divide that by 3. Well, that's a pretty easy amount. It's 10,000 and some change. $30,320 divided by 3 years. Each year we're making $10,106. How much of our own money did we invest? We invested $40,000, the difference between these two numbers right here. So what is our yearly return on investment? If you take $10,106 and you divide that by $40,000, every year, your ROI is 25.26%. Return on investment is 25.26%. Now, some of you guys are thinking, well, that's awesome. Some of you guys are looking at it going, I have no idea how that math worked. Some of you guys are going, is 25.26 pretty good number? It's a great number for an ROI. And we didn't do anything crazy here. We didn't even talk about buying the property at a discount. We didn't talk about using high appreciation here. We didn't talk about any of those things. We talked about giving back the difference that the tenant buyer needed for the non-refundable. Here's the cool part about it. I know some of you guys are thinking, well, Pip, I don't have that $40,000 for the down payment. Could we get an investor, split this ROI with them? I'll bet you guys might know some people that would want a 12.6% return on their money. They never have to talk to a tenant. They never have to fix a toilet. You split the cash flow with them. You make money. They make money. Everybody wins. This is a very basic example of the numbers on a lease option. And when you start to see how lease option allows you to make money in this deal, is that my wife commenting on that? That makes me laugh. And so when you start to see the ability to make money on these lease options, what you start to see is that you can bring investors to the table. So we're going to be talking more about lease option. We'll go more into numbers. We'll do numbers multiple times so you start to see them. And we're going to do that over the next, about 20 or 30 days or so. Probably more like 20 days, I think, is where we're at. More close to 30, I guess, before we really get into the next thing that we're going to be doing with some lease option trainings and stuff. So pay attention to the Facebook Lives, a lot of different information here. I asked you guys to do this before. You guys are doing a great job. Please share this video with people you know. Share it with people you think it might be interested in it. It's a great way to start educating. If you're a realtor, it's a great way to start educating your potential clients. If you're a mortgage broker, an awesome way to educate your clients. If you're an investor and you want to make more money than a traditional rental, because what did we not even talk about on this deal? Who takes care of the maintenance and repairs generally on a lease option? The tenant buyer. So we're just getting started with this stuff. A lot of different stuff going on. This is video number 6 in our series. We'll be doing a lot more of these. Somebody asked me how many videos we're doing. I said, I have no idea. I have not even really planned it out. I teach this all the time. I will usually spend the course of a weekend about 5 hours teaching lease option. And we've done 6 15-minute videos, so we're not even close to being done. We got a lot more stuff to go. And on top of that, we have 3-day classes on nothing but lease options, all the contracts, the spreadsheets, everything that go with it. So tune in to the next video that we do. Please share this video with other people. Like it on Facebook. Watch it on YouTube. All that different stuff. I can't even think all the different things I want to tell you. So please do all those things. Subscribe to the YouTube channel. Look forward to seeing you guys on the next video. Turn to somebody you know, somebody you don't know, and tell them you're going to be all right. We'll talk to you guys soon. Have a great day.